Hopefully this mic is on. Morning all, and welcome back to TradeTech Day 2. So first off, to the subject matter. I think we at Barclays Capital are of the opinion that, generally speaking, the market broadly understands that dark liquidity, systematically accessed dark liquidity, generally represents between 4 and 5% of the total market, yet continues to receive a disproportionate amount of interest at a conference level, a media level, and also at a regulatory level. And so we felt it would be helpful and interesting for the audience to focus on the 95%, i.e. the lit market, and the details around that. So in the context of that, there are three key or core themes that I'm going to cover with the help of my panelists this morning. The first is what is the real driver for committed market-making regimes, and do they adequately benefit the market? Secondly, with market maker obligations come privileges. What is the appropriate level to set these in order to promote market efficiency without giving an undue advantage or disadvantage to a market maker participant or a market operator? And then thirdly, does Europe need more stringent market-making obligations to create a more stable and efficient marketplace? Should those effectively acting as market makers be forced to do so by regulation? So I'd like to now introduce the panel who are going to spend some time covering these themes. So first off on my right is Daniel Coleman. Daniel is the Global Head of Client Services at GETCO, and was formerly the Global Head of Equities at UBS. To his right is Mark Hemsley. Mark is currently the CEO of BATS in Europe, and assuming regulatory approval, will be the CEO of BATS Chi-X Europe, making him the CEO of the largest MTF in Europe, and so therefore will be able to add some good European perspective. I'd like to welcome Joe Mecane, who, following an SEC meeting yesterday, has flown in from Washington this morning, so we appreciate you taking the red eye. Joe is an Executive Vice President, and he's co-head of US markets at NYSE Euronext. And then finally, to his right is Bill White. Bill is a Managing Director. He's Global Head of Electronic Trading at Barclays Capital, and formerly the Head of Barclays Capital Market Makers, which is a NYSE designated market maker. Something you're going to hear a little bit more about later on today. So first off, my question to you, Joe. Market makers exist in several different guises across exchanges and alternative venues in the US, Europe, and beyond. NYSE Euronext operates two distinct models for committed liquidity provision, namely the SLP and the DMM. So for the benefit of this audience, can you explain these two models?
Sure. I guess just for a little bit of context, the concept of being a market maker in the US over the last few years, largely for competitive reasons, has really been watered down to the point where, in general, people will register as market makers to get a few benefits, specifically the ability to internalize order flow, some capital benefits, some short selling benefits, but the obligations that come along with being a registered market maker, for the most part, have been watered down to just maintaining a quote in the marketplace. It's been refined recently to have a band around it, but it's not a very tight or meaningful requirement. On the New York market, we've always had an intentionally very different model where our market makers are held to, we think, fairly stringent standards. The first program that we have is the Designated Market Maker Program, which is the former Specialist Program, where members have trading obligations with respect to the market. They have to quote a certain amount of time at the inside price. They have depth obligations. They have to manage imbalances. They have to maintain a fair and orderly market. And in exchange for that, they receive two primary privileges. One is the ability to get parity on orders, which I think we'll talk about a little bit later. And the other is certain economic benefits that they get as part of meeting those obligations. We have an additional program called the Secondary Liquidity Provider Program, which has been in effect in the US for about 2 years, and we recently launched in Europe, which is our second level market maker program, where there's also a quoting obligation in exchange for heightened economics. Basically, the way we tier the economics on New York is, instead of tiering it according to volume, like many markets do, including other ones that we operate, we tier the pricing according to what the obligations are with respect to that market. And we think that the programs provide a number of benefits to the market in terms of price stability, lowering volatility, but the main area where we see the benefits play out is with respect to the market quality that we maintain on the New York, with respect to a number of different metrics that we try to be at the forefront, time at the inside, greatest size at the inside, and those are statistics where, as a result of a lot of these programs, we really think we're able to differentiate ourselves and provide a lot of value to the public market.
And so in the context of Europe, I mean, recently, I think, in fact, at the beginning of this month, you've introduced an SLP model into Europe. What are the drivers of such a model in this market from both, let's say, a market efficiency and a competitive perspective?
Sure.
And is it likely that the DMM model will follow here?
As I said before, the SLP model is, some of the details are different, but it's the same logic as we utilized in the New York model, where there's a quoting obligation or an obligation to maintain a market a certain amount of the time in exchange for an economic reward. And again, the same drivers are behind it in terms of producing more liquid markets, tighter spreads. We've seen the time where we're at the inside with the greatest size on our Euronext markets go from about 35% to 42% since we launched the program. So a lot of the benefits that we were striving to replicate from the New York market onto the Euronext markets have largely succeeded. As far as the DMM model, it's certainly something that we have in our toolbox. I wouldn't say there's any imminent plans to launch a similar DMM program, but clearly we can borrow bits and pieces from the experiments that we've had in our different markets. On Euronext, we have a lot of different models embedded within the pure price time model, but it's certainly on the table for consideration down the road.
I think there's a couple of questions I'd ask around those. I mean, firstly, I think one of the key differences between your SLP scheme in the US and the SLP scheme in Europe, which I think is one of the disadvantages of the one in Europe, is that the economics aren't transparent in Europe. Whereas in the US, you publish a price sheet, you get per 100 shares, you get a higher rebate on whether you're a DMM or SLP. In Europe, that's not a transparent scheme, and that's one of the big problems I have with what you've done in Europe around the SLP, is that it looks like sweetheart deals or hand-carved up deals can be negotiated.
Yeah, I wouldn't classify it that way, but the program's early on, and clearly there's still a lot of experimentation going on with the different parameters and dynamics. There's obviously a different regulatory scheme in the U.S. where we're forced to disclose at a pretty granular level any pricing that we have, which isn't applicable.
When you say that's a good thing?
Yeah, I mean, I think as we get more experience with the program and as we're live for more than a couple of weeks, I think we'll continue to be increasingly transparent with how the program works. But
so you will publish the pricing in Europe?
I mean, I'm primarily U.S. focused, so I can't really speak to it, but I think the intent is to obviously be more transparent as we get more experience with the program.
And one interpretation of the SLP scheme following the DMM scheme in the US was that part of the concern from other market makers was that there was a single specialist, as it were, in the old parlance. And the SLP scheme was to widen out access and market-making provision. Is that the reason you're not gone for that in Europe, to avoid that situation?
No, I think it's a slightly different reason. There's a fairly robust infrastructure to support the DMM model in the U.S. It's not an insignificant undertaking because the system and the market structure to support the DMM model is not insignificant. We had the former specialist model in the U.S., obviously, so the DMM model was really a way to adapt the model that did exist and that had become fairly commonplace in the U.S. market. So it was really more of an evolution. And as we became, as we changed the New York market from primarily a manual trading environment to one that was more electronic, and really adopted a lot more of the high frequency type algorithms in the marketplace, it became more of the natural evolution for the New York market.
Okay, let's
does
come
that
back a
mean
little
the
bit more
DMM
to
would
this.
drop as well? I was going to say, does that mean DMMs are likely to go away and it would just be a SLP scheme like you've got in Europe?
No, I don't think that's the case at all.
As you know, Mark, I've got a few questions on its implications in Europe to follow, so I don't want to dive too much further into that right now. Question for you, Bill. Questions have been raised whether market makers are providing enough liquidity at the right time, i.e. continuously quoting insufficient size. Much criticism has been directed at firms removing their liquidity during the flash crash on the 6th of May, and that market makers should not have allowed prices to dip so low. In particular, in times of stress, what should the role of the market maker be?
Well, as Joe alluded to on the DMM model, it's a balance between what our obligations are to the market and what our benefits are. And when we talk about obligations, we look at a broader world than probably everyone perceives. We, first of all, have obligations to the New York Stock Exchange. We take the role very seriously. As Joe alluded to, we have depth guidelines, which actually define how much liquidity we should be entering into the market at every situation. Number two, we have MBBO requirements. How much liquidity do we have to have MBBO consistently throughout the day? And those come together as defined as really a market strategy. What are we actually offering liquidity? But our obligations extend further than that. We do have regulatory responsibility. You see in a situation like the flash crash, the regulators show up at our door. They want to walk through every single trade we've made during that time. If you look back to May 6th, we never at one point during that day had our algorithms out of the market. They consistently were pricing liquidity in a lit market and in a dark market, all on New York, accessible to the clients continuously throughout the day. We traded the most volume we ever has as a market-making unit on May 6th and consistently operate inside the New York model. What really protected us that day, and when we evaluate, as we said, benefit and obligations, is can we deploy our capital efficiently in that market? And early on, when we looked at the model and decided to get aggressively invested into the New York model, one thing that was particularly important to us was their LRP function, the liquidity replenishment point, that in times of excessive stress or excessive market movement, there is a trigger to halt the market, to bring the human back to the table to say, what do we need to do in this situation? It's very important to the market, and not only that, you've seen time and time again, we've seen errors into the market that the LRP is able to step up and say something is not inside the ordinary, this needs to be looked at. A lot of times we've recognized errors and been able to go back to the counterparty and said, do you actually want to trade 1 million shares in the stock that has an ADV of 4,000 shares? A very important trigger point. If you look to May 6th, we take the responsibility very seriously. As I said, we were never out of the market. We continuously offered liquidity. And when we did hit the LRP, we stood up, we offered as much liquidity as we needed to open the stock. I think it's very important that we had the functionality to not only price, but to keep the market trading effectively. As I said, the last obligation for us is we have a direct relationship with the listed company. So as I explained my story to the regulators, as I explained my story to the New York Stock Exchange, the final client of ours is the listed company. As a Barclays, we take this very serious as well because most of these companies, we do have banking relationships. So our market quality and ability to affect our transactions in that market are very important to them. When I have to sit in front of a CEO of a Dow Jones company and explain to them exactly how we interacted through the market. So you talk about benefit and we talk about obligations. Outside your normal market-making obligations, we carry a vast amount of obligations that the public market doesn't really understand or perceive that we have. But every trade we put our name on, we think is that as a selling point for the firm. So we look at the DMM model not only as a pure market-making model, it's actually a brand recognition and something for us to go out to our clients and show we have the expertise to interact with this market, understand the market, and develop the relationship in that manner.
Okay, so we're going to turn now to the first audience question. Hopefully this technology will move things forward. Okay. So again, using your touchpads in front of you, which of the following should be included in the role of a market maker? Number 1, maintain an orderly market. Number 2, continuous two-sided pricing. Number 3, quoting in decent size. 4, price support. And 5, issuer relationship. Okay, so a reasonable spread. So 12% of the people are saying it's not for price support. What do you think, guys? Any comments on this?
I'd say that's probably correct. I mean, the role of the market maker is to facilitate the transfer of or create liquidity between buyers and sellers. It's not necessarily to support any such pricing level. So.
Yeah. I mean, I think the most important thing is, as we look at it, is a fair and orderly market. That is, at the end of the day, our responsibility. There's times that we can inject volume and liquidity into the market that is going to allow the auction process to happen very quickly. And there's times that we need to offer liquidity, as I said in LRP, that we really need to commit sizable capital. But having the ability to operate inside an exchange that has this function is very important to us. And again, the main responsibility to have a fair and orderly market. A lot of these things are required. As Joe said, the infrastructure of DM is very large. Our infrastructure is very large. These are the tools that we need to conduct an orderly market. And I would agree with the assessment of the crowd that these are very important factors in our market-making decisions.
Okay. So turning to the next illustration, let me just explain what this is. So we're looking here at a Dow Jones stock during the flash crash. On the x-axis is a time frame, in fact, of 10 minutes from 241 to 251, and on the y-axis is the stock price. In the white, you can see the price of this stock on the NYSE, and in the red, you can see the price of this stock on the composite exchanges during that period of time. Now, this slide was supplied to me by the NYSE, and clearly, makes it look pretty good. A lot of protection afforded here to the sellers in this particular stock during this time of stress. But as Bill alluded to earlier, this seems to be much more about the role of the LRP, the liquidity replenishment points that kick in at times of certain stress. You can see in the other markets that despite the fact the stock dropped to 39, it rebounded quite quickly to 62 and then in line with the NYSE quotes over a period of about 2 minutes. So the question is, at first glance, it might appear that the DMM model has helped facilitate this, but in actual fact, in times of real stress, the DMMs haven't actually performed that stringent obligation. It's a circuit breaker, if you like, that's helped. I guess the question for you, Bill, is at this particular moment in time, what exactly does a NYSE DMM do?
Well, again, we've gone into a slow process, so if you see the line go flat, it's triggered the LRP. So we're in a slow market, we're assessing the situation, we're letting natural order flow come in and pair off, and as you see, when we open it, you see a tick up in the stock. I will tell you, when we open that stock, the volume on that complete descent away from the flat line and the move back up, we traded more shares as a market maker on the opening print that was traded away in that whole movement. So again, assessing the situation, let natural buyers and sellers come together, find a centralized auction place, we're able to prove that the model works in that situation. I think what actually validates the New York's model is after the May 6th event, the U.S. has adapted the circuit breaker model, which is basically another similar mechanism as the LRP. So looking at it, this situation that we have to have a centralized mechanism across the entire market that the central auction can happen without the huge deviation away from what is realistically the market at that time. So this slide was used in many situations, mostly presented to the regulators to show the differentiation between an open market with really no central auction place and having one auction conducted. And again, that's why these circuit breakers were created.
Please, worth making some other comments on that diagram, though. I mean, I think firstly, when we say it's NYSE, that white line is the NYSE floor, I think I'm correct in saying.
No, it's the total NYSE market.
So ARCA as well?
No, and it's the New York Stock Exchange, not ARCA.
So, but on ARCA, if I remember rightly, actually showed that same electronic price drop and actually had thousands of trades busted as a result of that.
As did all the electronic markets. So
That's correct.
So
I'm saying that the line across was effectively the LRP stopping in, which was the volatility. So I think the things that came out of that to extend that was that there is sense in having coordinated circuit breakers, and I think the limit up, limit down structure is the one that seems to be they're moving towards now, which is something akin to what happened in the futures market. And so, as Joe said, that represented all electronic markets, including NYSE ARCA. So we had a different model on the floor to that which was implemented electronically in the systems. The other big thing that came out of that was that, and in terms of what probably isn't part of the general market maker schemes, was that there were a lot of erroneous trades. So many of the market makers, perhaps not in the same types of schemes as Joe's been talking about, were in a situation where they didn't know whether their trades were going to stand. And so at that point sort of withdrew market making capital as well. And I think that the conclusion going forward, and the interesting thing is potentially applicable to Europe as well, is actually what's happened is you've got a limit up, limit down structure which will be coordinated across the markets, which in theory eliminates erroneous trades, because what it should do is create a situation where market makers or anyone in the market is either getting done or not done. There's nothing, it's not a situation where you've been executed on and you might get torn up later in the day, which means you don't know where your risk is. So there's a couple other comments around that.
I agree with Mark. I think one of the real weaknesses of the U.S. market May 6 was a different structure for different markets with respect to slowing down or trading or stopping trading. Meanwhile, you had routers that were continuing to go. You had certain obligations that needed to be met, and it really wasn't clear what should happen. I think one of the most important changes will make sure all trading venues have the same sort of way to deal with situations like this and stop trading at the same time in the same way. And I think I think we're learning a lot, and it may well be that the LRP was a good way to show us this. But the fact is, we had different venues with different rules, and these are not the kind of rules you want to compete on.
Yeah, and just for the audience, in case it's not clear, LRPs have been in existence on the New York for a couple of years. What was allowed from a regulatory standpoint is other venues were free to either comply with the LRPs when we were in those mode or continue trading. Some venues follow the LRPs and some venues don't. Most days it's not that noticeable, but obviously May 6th was an extreme example. So as Bill alluded to and as Mark mentioned, following on the May 6th event, basically the circuit breaker and now the limit up down is essentially taking the LRP concept but mandating it market wide as opposed to leaving it to people's discretion to choose whether to pause or not.
Okay. Daniel, so electronic market makers such as GETCO have been trading around the globe for years, making a profit from spread and rebates, etc. This market making activity, particularly in equity, has been performed by your firm largely on an optional basis. But more recently, we've seen GETCO step into the more formal shoes of an SLP and a DMM. How did you go about evaluating the DMM opportunity, given its associated obligations?
Well, we've been making markets around the world for about 11 years, in Europe since 2003. We looked at what we did already, the amount of time we're on NBBO, the amount of liquidity we provided, and we saw an opportunity to be an SLP with New York. We were an SLP on a large number of names. And then we saw an opportunity to be a DMM, and we thought it fit our business model and what we did. In addition, we saw as an additional benefit to get closer to some of the end clients that we've been trading with through years via exchanges, and to partner with one of our good partners, New York Stock Exchange. It's been a good move for us. We've been a very involved participant as a DMM. We won the GM IPO, which we're very excited about. But we see the DMM as just an extension of what we already do.
I would agree with that. That the unique part of being a DMM as well is as a firm we're agnostic. We trade with every single exchange globally as well. But to have the ability to sit down with an exchange and really talk about business models, really flush out the issues of LRPs, have that ear and the conversation happening that we could really sit with our clients and tell them where we see the market structure going, what input we have on it, what do we think is the best for the market. It's a great seat to have, and have partnerships in New York, Stock Exchange, BATS, et cetera. That's really another additive value of the market making business, that we are part of the decision process and do have a voice into most of the exchange structure and the decisions that are coming out.
So Mark, one of the core aims of MiFID is to foster increased competition between trading venues, and many applaud the current legislation for having done just that. Yet we see the EC's consultation, new proposals to further improve the level playing field between regulated markets and MTFs. If a major European exchange launches a committed market-making regime, such as a DMM model in Europe, how will that impact the competitive landscape, and what will the consequences be, if any, for the pan-European MTFs?
Well, I think firstly, certainly I can speak for the MTFs in the UK that are regulated by the FSA. The FSA absolutely regulate us in exactly the same way as they would do an exchange. They have a mantra of if you're doing an equivalent function, you'll get equivalently regulated. So the regulation and the monitoring on the MTFs is as strong, or if not stronger, than some of the incumbent exchanges. So to the second point, we're very open to discussing market-making schemes, but I think the key word is open. And so from our point of view, I think that the transparency associated with market-making schemes is very important to us. We spend a lot of time trying to make our pricing very simple and straightforward so people can understand it and use it in the market. And if we were to go to sort of market-making schemes, I'd want those very often. And as alluded to in the earlier comments I made, I think that in the US, if I look at the pricing of the SLP or the DMM schemes in the US, I can see how many cents per 100 shares that you're going to get rewarded. I can understand the rebate. If I look at that in Europe, there's a sort of line that reads something along the lines of SLP schemes will be agreed with the individual parties, which I don't like, because that means that opens up subjective judgments, individual deals done with individual parties, different structures. There's no transparency in the SLP scheme from the point of view of how firms are going to get rebated. So I would support it being very open in terms of the economics of it. The second thing is being open to firms that come to do this. So there's not a sort of subjective element to it. We can say if you meet certain economic, possible capital criteria, etc., you can be part of it. So firms that fulfill the obligation are open to it. So it's not just locked up with a smaller number of firms. I believe in that sort of being an open way of actually handling things. So I think that's very important. And then from a market center point of view, I think that some of the things that Dan was just talking about, where bringing into the market and coordinating across markets things like common approaches to limit up, limit down, or other sort of interrupts, and then also saying that markets should actually have certain obligations. From our point of view, we regard those as being obligations for market stability, which are functional in terms of we're looking and surveilling for market abuse, and also technical in that we stop the accidental electronic blow-ups or the rogue boxes, etc. So I feel that in terms of market stability, I'm very behind open and transparent schemes for market makers. I'd like to see a common scheme for limit up, limit down across the markets. And I think market centers have an obligation themselves in being able to provide capacity and strong technical and market abuse surveillance as well.
Okay, so touching on the issue of, say, listings and issuers, Joe or Bill, what is the relationship between a DMM and an issuer, for instance? Just talk us through how that operates.
I could start and Bill can pick it up, but There's a very strong relationship between the DMM and the listed companies in the U.S. A lot of IROs at the various listed companies that want information about the market, what's trading, what might be happening with their stock, rely on the DMMs as their primary source of information. We supplement that with a lot of additional information and services from the exchange that we provide on more of a market-wide and agnostic basis. But it's really a close relationship between the firms in terms of how they keep their ear to the market and get a color about what might be happening in their stock. As Daniel alluded to, with any IPOs, there's an interview process that happens where any firm that's coming to the market interviews the various DMM firms and selects the one that they think is best suited for them, and then we publish regularly various statistics about how the DMM is performing in their stock, what their participation rate is, how the stock is stacking up versus its peers, and we make it very transparent to the issuer so they can continue to evaluate, what impact the DMM is having on their stock.
Right. I always like to say we're the only, the market makers, the only market maker groups in the world with our own IR team inside. That the relationship is very consistent, that you have companies that will call us. Some clients want to talk to us on a daily basis, some want on a weekly, but every time there's an impact or a move in their stock, they want to come and understand really what did we see? What did we see was the impact? Was it a technical move? Was there information moving around the street that they need to be aware of? A lot of times we'll reach out to their company saying, there's an issue here, there seems to be a lot of selling pressure, let them be aware of what's happening on the floor. So if there is a news release they need to put out or there's something they need to address, that communication's there. I think they look to us, the CFOs look to us as they come into the annual reports, looking at what the real stock value, what the stock movements have been, who have been active in their stocks. Is there something they need to do on their side, reach out to a particular group because they've been either buying or aggressively selling their stock. So as Joe said, we're sort of their eyes and ears in the point of sale. And it is a very interesting relationship because we look to build those relationships from the listing company and actually introduce it into the banking side. We lead with our market quality, we lead with content, and as we develop these relationships with new IPOs, we try to introduce them to the bank. So it's a full cross-selling across the firm, but again, we have to lead with market quality or the relationship breaks down there.
Just one question on that. In that role, given that there's an increasing amount of trading either happening on the ARCA platform or happening on BATS or Direct Edge or NASDAQ, and you're in that role talking to an issue, do you also comment on the entire electronic trading side as well?
Exactly. The question always was, well, how do you have so much content if you have X% of market share? Again, they're looking for us on a professional level as a market maker. What do we see in the overall market? Where do we see the flow of liquidity? Where do we see the movement of the stock? That we speak on a broad base. We don't speak particularly to any venue. We're there to give them information on impact and execution quality, and we look holistically at the market when we do that.
And I think that's got to carry through into Europe if you see these sort of schemes, and part of that DMM relationship or market making relationship is with the issuer. Given that there's an increasing amount of flow traded across the larger MTFs, when we bring together a BATS and Chi-X, you have sort of 35% of the UK market, and actually, over 50% of some stocks traded on our market as well. So I think that when you look at that sort of qualitative issuer commentary side of it, they're going to be looking across the market, not just the trading directly on the listing venue.
Yeah, interesting. Actually leads on to the next question, Mark. In that, your boss Joe recently released a statement in the States that said that BATS had an intention to seek to launch a listing business. He commented that he saw opportunity if, for instance, the NYSE and the NASDAQ came together to create a competitive listing business. And seems very plausible, but at the same time, is there maybe recognition that this listings business actually and the relationship that the issuing companies may end up having with liquidity providers might be the real reason behind it?
I think there's two reasons behind it, and the one you suggest probably isn't among them. The first one is that generally from a point of view of service, what we're hearing is that there are potential gaps where a different type of listing service or a different type of approach by a company may have a market, and of course that given the potential NASDAQ NYSE situation as well, where there would be a monopoly situation for listings, there may actually be regulatory resolutions to that may potentially force some delistings as well. So I think it's a sensible strategy in terms of our capabilities in exchange in the US and recognition of the real market at the moment. The other key thing that a listing gives you is the auction. And as we see both in Europe and in the US, the venues such as BATS in the US, if you look at Chi-X and BATS, you'll see a tremendous amount of trading happening during the day. Then at the end of the day, roughly 10% of our percentage of the market traded disappears into the auction. And I think that certainly at the moment where there's not a desire for multiple auctions, the opening and closing auction are tied to the listing venue. So I think it's a very coherent and sensible approach to do that. And from a competitive point of view, again, we've seen this in Europe, is where the MTFs aren't directly competing. And if you look at, say, the auctions as a case in point, that's where there's been increases in pricing. And so, we're looking for ways to compete in that, but a lack of competition has seen pricing increases relative to the pricing in the rest of the market there. So I think, it's a competitive situation. It's a logical move forward for an exchange.
Okay, we're getting sort of towards the end of the panel now, so a couple more areas and then we'll open up to questions. One topic addressed in the EC's MiFID II consultation and the CFTC-SEC joint flash crash recommendations touches on the issue of market maker obligations. And as you know, the US has a very different structure of obligations versus benefits. Is there something that should be done to impose additional obligations on market makers? So those that are operating as high-frequency trading firms today but have a market-making strategy, should they be forced to register as market makers? So I have an audience poll on this one. Yes, no, or don't know. Okay, so fairly even split there. For those that, the majority that have said yes, why do you think that is? Daniel.
First of all, at GETCO, we think anyone who has direct access to markets should be regulated. So if you're a high-frequency trader with direct access, you should be regulated. So that would be step one, even before market maker obligations. The second, I think, is a fundamental question. If you think the new data warehouse is the new floor, and you have certain privileges for co-locations, perhaps you should have certain obligation for it. I think it's difficult to lump high-frequency traders as any particular type of trader. Anyone with co-location could be any number of types of traders, but I don't think it's unreasonable for regulators and exchanges to explore ways to increase obligations on firms to make markets. After May 6, we wrote an open letter with Virtue and with Knight suggesting various type of obligations that firms can have. And I think while market maker obligations would not have stopped May 6th, I do think market maker obligations, or a little stronger obligations than what we see right now, can provide better liquidity throughout the markets during almost any type of market environment. So from a GETCO perspective, we actually think market maker obligations do, stricter ones make sense for firms that are actively trading. Wouldn't necessarily categorize it as high frequency, except for the fact that you could argue that co-location is a privilege, and to the extent that not everyone can have it, perhaps there should be some obligation there.
I agree. The only thing I'd add is I always feel like this topic confuses two different things. One a regulatory one, and then the other a market-making one. A lot of, I think, the impetus for this type of discussion was because from a regulatory standpoint and from a market concentration standpoint, there was a feeling that there wasn't enough disclosure and the regulators didn't have enough information about, you know, the various high-frequency strategies that were out there, how much concentration was there, you know, who's accounting for the largest parts of the market. And I think that led to a conversation about whether there should be more obligations put on those firms. And I think there's two different paths, and the SEC in the US has gone this way, where the tracking and the regulatory piece is getting dealt with separately through, you know, a consolidated audit trail proposal and a large trader report. And then I think there's a separate debate about the market-making registration, and I think that largely just comes down to the balance of costs and benefits. You know, to Daniel's point, to the extent that someone is clearly getting benefits because they're operating like a market maker but might not be registered as one, then that's certainly valid. Where it becomes a slippery slope is someone might be actively trading but not necessarily getting any of the benefits of being a market maker, and then the question in that case is, well, you know, should you really force them to have these additional obligations if they're not really getting the benefits? And I think that's the balancing act that we're trying to figure out.
There's also a few layers behind that question, because I mean, I think that I think there was some commentary earlier this week when people were talking about in Europe, for example, whether the trading firms should be regulated. I think there's an argument for that in terms of identifying them. You know, some of the more extreme views were that the regulators should be able to sign off algos and things like that. I mean, that's just never going to happen. It's completely impractical. So I think that they would look at you just like they would do with any regulated bank, where they look at risk models and valuation models, and what they want to see is process. You know, do you evaluate these things, test them? Have you got a safety net of some form if they go into production and go wrong? You know, that's what they're looking at. So I think that's one element of it. And also, when a lot of this commentary, the sort of debate was really getting pushed, especially in the US, it was straight after the flash crash, before anyone had actually identified the sequence events that actually came to it, and it sort of trailed back to, I think, as everyone knows now, you know, the initial order and then the sequence of orders that happened that actually created that snowballing effect of orders that caused the drop. Now, I think the reality of that is these market maker obligations aren't going to stop that sort of situation, in that there was no firm that was going to stand in front of that amount of money coming at them and make markets in that. What was going to happen was exactly what happened, was that there was an LRP stop, and exactly what is being put forward now is that we have consistent limit up, limit down across the electronic markets as well. And that's the right thing. That's the thing that will stop the precipitous drop and give everyone a chance to react properly to information in the market. So I think it's an illusion if you think that purely having market maker obligations without some of these other things would stop the drop. It's about having the right market infrastructure things together. So I think in Europe, it's a good idea for liquidity purposes that to talk about these sort of market maker schemes. But you've also got to learn the other lessons of a limit up, limit down structure, etc., that gets in the way of one of these snowballing effects of orders. So, as I say, I think the actual question underneath is far more complex.
Okay, so we've spoken quite a lot about some of the obligations. Let's talk a little bit, my last question on the privileges. Bill, for the benefit of the audience, this on the NYSE is quite an interesting one, probably not widely understood here, albeit something similar to that was introduced by Nightlink in Europe fairly recently. Can you just give an explanation to the crowd of what this parity benefit is?
Parity in the New York model is a guaranteed participation rate, meaning if a trade comes through, what benefit does the specialist have to interact with that? But I think, again, you have to look at parity, how it's set up holistically. New York has, the first part of parity is anybody that comes into the market and sets the MBBO guarantees 15% of any inbound order. So it's already diluted the parity pool. Number two, we look at, again, across our entire book. On New York, we make markets in 1,526 stocks. you can imagine the liquidity profile of the majority of those. For us to be able to offer consistent liquidity across our entire portfolio, we need to be able to interact with the flow coming in so we can manage the risk profile as well. So if you look to how parity came about, it was actually a complete reorganization of the business. The traditional specialist on New York would have the order information, understand what the order was, and be able to make a decision with complete ownership of the order. A few years back, we went down the road of saying we need to bring clarity to this model, and actually took away all privileges of the specialist to actually own the order coming in. There is no information disseminated to the specialist. We're required to have a two-sided market. We're required to offer liquidity under a strict guideline. In order to do that, as we've talked about obligations, we need some type of benefit. The benefit is able to interact with the order flow coming into the exchange and able to price effectively. You know, it is disputed as, is it too much of a benefit, is it not too much of a benefit? But, you know, in the U.S. with the multiple market structures, you know, the clients are going to vote with their market share. If they're not comfortable with the markets we're giving up, if they're not comfortable with the allocation of trade to them, they're going to move on to a different venue. And I think we've validated that with the market quality and our ability to interact, that we're offering enough liquidity that their experience is beneficial to having parity on the specialist side.
If I could just add one thing for context without getting into too much detail, because the way parity works is a little involved, but there's really a couple of different pieces to the parity model and the way we operate it. There's three primary parity buckets. So the first bucket is the DMM bucket, the second is the public book, and then the third bucket is the broker, which is primarily institutional. And those three buckets essentially get to participate and split prints on any incoming orders. As Bill was saying, the DMM bucket is largely set up for the purpose of allowing them to meet their obligations and that cost benefit. The book obviously gets its own bucket. The broker bucket or the institutional bucket is sort of the interesting one, because the reason it was designed that way was to allow institutions to get to the front of the line without necessarily having to compete with whoever's the fastest one to the market and the first to get there. Obviously, in every bucket, sometimes it works for you and sometimes it works against you. If you would have been first, it obviously works against you. If you would have been joining, then it works in your favor. So as Bill said, it's a trade-off, but it's a different market structure. It's a way for us to provide different execution experiences for people, aside from just the pure price time priority markets that generally exist elsewhere. And that's a lot of the feedback that we get from our customers, from our market makers, as to why they like trading on the New York model, because it is a different trading experience.
Okay, that's just about it in terms of time. I think we have time for a couple of questions. So if there are any questions, if you could raise your hand. When you have a mic, if you could give us your name, company you work for, and who the question is directed to.
Hi, Tristram from Barclays Capital. It's a question for Bill, actually. There was a good presentation by Andrew Silverman yesterday, and it was regarding broker crossing networks and liquidity providers. And his issue was that if you trade in a dark pool or a broker crossing network, you can get information leakage, so that when you have the rest of your order goes to the lit markets, you end up having the flow fade away, so you end up losing liquidity on the lit markets. What's your view on that?
I guess it is there information being disseminated to the dark markets that is impacting the lit market? You know, from my other seat from the electronic business, yes, you know, we have to understand as a company what information we're exposing the market to when we go outbound. We analyze stock specifically and understand how to access liquidity, and a lot of that knowledge was embedded in how is our market making business built, and what information do we look for market impact. So the notion that all information hidden in the dark pool is creating an issue in the listed market is not relevant, I don't believe, because if you understand how to access dark liquidity properly and accessing lit liquidity properly, your impact for your client will be twofold, meaning we can find liquidity very quickly in dark venues and access the lit market if you know how to actually access the market. And that goes through the logic of your smart auto routing. What impact studies are you doing? How are you creating your execution table? How are you executing against that execution table. So there's a lot of input that's generated on a single stock information and understanding what the real world in the dark is and how to access liquidity properly. It's a bigger statement than just saying you're being gamed from the dark pools. There's ways to interact that you could bring it to your client's benefit if you understand the actual functioning of that market.
Okay.
Raj Nagella from Citigroup. Question
Can't
for,
hear.
Can you guys hear? Raj Nagella from Citigroup. Question for Joe, and actually Bill and et cetera. From a DMM perspective, I'd be curious to know what percentage market share increase you've seen, number one, and number two. And I was involved with some of the parity discussions a few years back when I was at the NYSE, but would like to know what you would change based on the experience of the last 2 years on the DMM model.
It's good questions. In terms of complicated dynamic, but you could use those percentages as a rough gauge. Again, there's only so much one participant can do with regard to moving the market share needle, obviously. So, the primary goal of the liquidity provider programs isn't necessarily to move the needle on the market share as much as it is to improve the market quality and to make sure that we have the best market quality in the industry, because that starts a feedback loop, we think, with the routers and all the other participants to build up share. So I think it's more of an indirect relationship than a direct one. We've made, as far as the second part of your question, I don't know that there's any obvious changes that we would look to make to the model right now. I mean, obviously, we've made tweaks along the way to how the model works. And there's a few things we've considered, but if there were any substantive changes, frankly, that we'd want to make, we probably would have made them. We're always monitoring the quality on the markets and tweaking accordingly. We've made a number of pricing changes to try and get things in line, but structurally, I wouldn't say we have any big items that we think need to get addressed.
As Joe alluded, we've gone through a lot of changes over the last 3 or 4 years, again, bringing a lot of transparency to the business, making sure the pricing was right, making sure the technology was fast enough for Interact. So I would have to say, really nothing coming new on any level. We're pretty happy with the existence of the model and our ability to interact down there. So I think we're at a point where, as Joe said, we're watching the market structure changes, looking for any changes in regulatory environment, and I'd say currently we're pretty happy with the existence of that model.
Okay, unfortunately we're out of time. Obviously the panelists will be around to go to the Barclays Capital stand. I'm sure you'll see them all there. At this moment, if you could join me in thanking them for flying from across the other side of the world to join us today.